Good afternoon all. Thank you very much for joining us. I'm Harry Robson, Tax Efficient Investments Director at Light Tower Partners, and I'm joined this afternoon by Andrew Wolfson, a man who needs no introduction, but the CEO and CIO of the Pembroke VCT.
Thank you, Harry. Good to see you all, and welcome to the Pembroke webinar. We are now a mature VCT. We're just over 200 million under management, with 45 growth stage companies in our portfolio. We were set up in 2013 to find entrepreneurs who we thought really had what it takes to create to build the businesses of the future. So we're very much by entrepreneurs, for entrepreneurs, and we invest in sectors that we really understand and that we have significant knowledge of. Those sectors are design, education, food, beverage and hospitality, wellness, digital services and media. The VCT has performed well over the last 5 years. We've slowly increased NAV, and it's obviously been our intention to increase NAV, but also to return significant amounts of money to our shareholders. And you'll see our latest June 22, we have returned 30 pence per share to our investors, and we have a current NAV of 117.6. We have obviously, with the economic uncertainty that we have at the moment, taken probably an overly critical eye on all of our portfolio companies, as we did at the beginning of COVID as well, because while there is uncertainty, obviously fundraising is slightly more unsure. So we have prudently taken a slight down on our NAV, but we've got lots of companies within our portfolio that we think are outperforming. So we hope that adjusts upwards at some point in the future. This is a slide showing our cash return to shareholders. We had our first really significant buyback in March 22, where we returned buyback, and there will be another buyback in April 23. And we look to return as much money by way of dividends to our shareholders as and when we get exits. So we have now increased our target dividend to 5p a year from 3p a year. We have already paid that 5p this year, so any further distributions by way of dividend are going to be on top of the 5p already achieved. In the 12 months to July, we have invested 15.5 million into new companies and 33 million into follow-on companies, roughly in line with what we set out to achieve last year, which was a third into new businesses and 2/3 into follow-on. We think that the founders we've backed in our new companies really have what it takes to grow businesses in these somewhat uncertain times. Now, all of these businesses were really launched and started trading during COVID, or maybe slightly before COVID, during COVID, and continue to grow. So they know what it's like to have to pivot and pivot and pivot in order to grow your business. And a lot of our follow-ons are also founded during times of uncertainty and are now really overachieving because they understand how to do business in uncertain economic times. So we think our portfolio is really well set for the future, and we will continue to carry on investing on the same sort of basis, where a third of the money that we raise this year will go into new investments and 2/3 will go into nurturing our companies with follow-ons. So the Pembroke team has evolved over the last year. I guess the one area that we really have tried over the last couple of years to get better at is portfolio management and reporting. And we've now got a really good team of Jamie Kennell, Dilesh and Christian, and we're actually being joined by a new starter in September. And the amount of time we're now able to spend with our founders, really helping them recruit the right people into their businesses, get the right financial reporting, get the right marketing, and really then help them develop strategy. So we feel that we've spent a lot of time over the last 12 months making sure that our portfolio is, or our portfolio management is really well set for the future to be able to help above and beyond what we've been doing in the past, our founders and management teams. The investment team of Simon, Fred, Angus, and we've just been joined by Jennifer Wren, continues to see a lot of new business opportunities and carry out due diligence on them, and works really well with the founders, really selling Pembroke and what we add to their team once we become investors. Operations is very well managed by Chris Lewis, Orla, Rosie and Cordelia. And then we've got the investment committee, who we feel once again that we use our investment committee in a slightly different way. In that investment committee get to see opportunities before we take them into due diligence. So we sift through the hundreds of opportunities or thousands of opportunities that come through each year, and we'll get the founders to present to our investment opportunity on an ad hoc basis, so that they can ask the questions before we go through a lengthy due diligence process. So obviously we carry out due diligence, but we get their sign off to carry out due diligence before we waste the founders' time or our time. So it works really well. The founders of the company, once we do invest, also have access to our investment committee to then ask them questions, and both John and Ruth are hugely experienced in their industries. So we're launching another fundraise, very exciting. We're launching another £60 million fundraise, 40 million under 20 million over allotment facility. We're targeting a 5p dividend, which we have already paid this year, but we will obviously distribute more cash to shareholders as and when we get exits. We have a maturing portfolio of over 40 companies. And one thing we don't do, which we never have done, is charge any fees on our underlying companies. And it is, funnily enough, a big selling point to our underlying founders, because there's no point in them getting diluted to take our money to pay us money through the back door. So we don't charge arrangement fees, exit fees, directorship fees, or monitoring fees. We will, of course, if they place a third party non-exec director or non-exec chair, that will be an arrangement between the company and the individual. The cash position as it is at the moment is we have roughly 10 million of unallocated cash. So as we go through the year, we see that diminishing as we make more investments. So your money, if you do invest in Pembroke this year, we will start deploying it really as soon as it's allotted, so there is no cash drag. So how do Pembroke add value? Everyone has this slide, and it slightly irritates me because I don't believe, or Pembroke don't believe, that there is a one-size-fits-all model. The way we work with founders is we ask founders what they want from us, and in every case, it's different. So we like to see every investment opportunity as a completely unique opportunity to work with a new founder, a new management team, and really help them in the way that they think we will be of most help. We don't tell people how to run their businesses. They hopefully have great lines of communication with us, and we work with them to really work on how we provide the most value add through introductions or through our strategic advice. So our investment strategy has not really changed, certainly over the last 3 years. We very much back founder-led businesses, and we look for exceptional founders who really understand what the problem is. I think what has changed is the sort of people who we're backing as founders. And what we've seen sort of since I've been doing this over the last few years is people coming out of big industry, big businesses, large sectors that have been maybe underserved by innovation, especially innovation in tech. People who understand what the problems are, and they set out to then solve those problems. And let's face it, it's never been easier than it is today to start a business. You've got crowdfunding platforms, you've got shared workspace that you can get desks at very cheaply. You've got LinkedIn to be able to recruit. So what we're seeing is people in their 20s, whether they go to university or don't go to university, going off into the workplace and really seeing their early working life as a very transient place where they get different skill sets. And only once they've got some skill sets, they really understand how to solve problems. And so we're starting to see founders who really understand what the problems are, and they set about solving them. And they have an amazing talent of building teams and getting people into their companies out of other large businesses, because they understand what the problem is and they understand how to create the solution. So we still believe in a stepping stone approach. We don't like overfunding businesses at an early age, because what we like people to do is to really focus on 12 to 18 months of growth. You're never going to grow a £100 million business if you don't grow a £10 million business. And so what we really do is, although everyone presents us with a 5-year business plan that ultimately ends up in cash flow break even, we don't really trust business plans, because what we want to do is back people who are going to take advantage of opportunity as and when it presents itself. And as people don't have crystal balls on the whole, we see business plans as being an extrapolation of what their business is currently, but not taking into account anything that they might not know in the future. So we want founders and management teams to be really nimble in the way that they manage their growth, and things that work, go harder at, things that don't work, stop doing. So we really do try and focus on 12 to 18 months of growth, and we like to fund companies at relatively quick stages. So once they're really proving themselves, we will look at another funding round that hopefully we will get joined by other third-party funders. So going on to some of our new and not so new investments, Peckwater Brands, and founded by people who worked in the food industry and in the data industry, who really saw an opportunity to, rather than setting up dark kitchens or having a logistics business trying to deliver food, they would take what was already there. They would take capacity out of current operations, current kitchens, where they would create food brands that they would teach current owners and operators of kitchen facilities, restaurants, how to create a new brand. And then Peckwater looks after the marketing of it. They look for the data. They know where to launch a burrito brand, where to launch a chicken brand. So to all intents and purposes, the brands don't exist on the high street. They are created by Peckwater. We teach chefs in current kitchens how to create the menus. We have complete control over the supply chain, so the quality control remains fantastic. And then they do the marketing across a wide range of different delivery services. This is a case in point of one of our stepping stone investments. We invested for the first time in September 21. The business absolutely thrived, and we then took the opportunity to invest again in earlier on this year. So once again, showing that we back people when we have more confidence in the management team and the brand. We will quite happily back people. Coat is a business that we really liked from the first moment we saw them. They came to see us. They were actually, when they first saw us, they were too early stage for us to invest in, but within 3 months, they'd already hit the revenue points that we wanted to see. So we backed Coat. They've continued to thrive. We have followed our money with them once more, and they continue to provide real quality paint that is that has fantastic ESG credentials. It's environmentally friendly. Great management team, and they've now got a great B2C business, and they're also going into the B2B world. So again, another brand that is really disrupting an age-old industry that really lacked a lot of innovation, but it also lacked quality. And what they've done is really come out and said, we want to be really quality tech, but delivering the best quality paint we possibly can. Popsa is our photo book business that we first invested in 2018, and then invested at 3 subsequent rounds. They're doing fantastically well this year. They earlier on this year, they had a fundraising round that was joined by the current investors were joined by Gresham House, and they've really continued to leverage their really high quality tech that they've produced in making photo books really quickly. I don't know if any of you make photo books, but when I used to make them, it used to take me a long time to drag and drop photos from my Apple Photos into another online application. This I do all on my phone. I take the photos I want. It's fantastic. And they continue to go from strength to strength. Their revenue this year is forecast to be over 35 million. They have for the last 3 years running been listed in Deloitte's fastest growing UK companies in the top 10. So again, really quality founders, really great business, and they've built a great team. So we are delighted to have them in our portfolio. And then slide 15, One Plan is a fascinating business that again was a founder, Paul Foster, who came out of a large corporate, having helped them deliver the Olympics from an events management perspective, and realized that he was still using PowerPoint, Google Earth, and Excel, and set about changing that to actually design a program that made event management from a small event up to the very biggest events in the world, make them possible. So we were an early stage investor in May 21, but we really saw an opportunity to change the way events used tech to be able to deliver from a planning perspective. They last year, in fact, it was announced earlier on this year, they announced that they had won the tender to do the Paris 24 Olympics and Paralympics, and at the same time have signed up a number of significant stadiums, both in the US and in the UK, to deliver events planning and management tool. They continue to go from strength to strength and are really competing now for every major event that is held in the world. They've got a fantastic tool, and we are again delighted to have them in the portfolio. And having made our first investment in May 21, made a follow-on investment within a fairly short space. We very much changed our strategy in early 2018 to take on board the team that we had been able to build. And pre-2018, we were very much waiting for opportunities to come to see us. They were very much design-led and food, beverage, and hospitality. As you can see, they took almost 80% of our portfolio. Fashion brands and four-walled hospitality environments. You look at 2018, we've introduced education. We do a lot more in digital services. And although we've still got design and food, beverage, and hospitality, in design, we're really looking at direct-to-consumer brands that really have an edge and use tech to their advantage and are very focused. And in food, beverage, and hospitality, we're looking very much at food brands rather than four-walled environments. So we backed Hackney Gelato, we backed Secret Food Tours, and we will continue to look at opportunities in education, digital services, and wellness being our main ones. Obviously, we won't ignore the other ones, but we see the opportunities now and going forward as being very much skewed to digital services, education, wellness. So here's a chart of all our underlying companies and their value at March 22. On the left-hand side is our earliest investment, UFB, United Fitness Brands, which used to be Boom Cycle, to our latest investment, Animals. Green is an increase on cost, red is a decrease on cost. Obviously, the more green, the better, and I'm delighted to say that we do have more green than red. The ones we work hardest with are obviously the ones that are struggling, but we also get very much involved with the strategy of the ones that are really performing well, so that we don't trip up on those ones. I'm pleased to say that there are a number of companies on here that have made gains on top of what we show at March 22, and those next ones will come out in the September accounts. So this shows the top performing businesses in our portfolio from an increase on cost perspective. Lima, Thriver, Popper and Five Guys all doing unbelievably well, all very well funded, and all really set for growth over the course of the next 12 to 18 months. So we look forward to working with them and reporting information on them later on in the year. It's not all such a rosy story. We do also have companies that are finding life a little bit more difficult. High Stitch and Story, Second Home and United Fitness Brands make up our worst performing, where there is a decrease in value on cost of 9.6 million. But it really does go to show how we do value things in real time. And the fact that this is already built into our NAV means that actually, if these businesses don't recover from their current position, that there isn't that much further impairment for us to take. Now, we're obviously working very hard with all these businesses to make sure that they stand the greatest chance of getting over their current situations. And we continue to do that. And that is why I said earlier that we've really beefed up on our portfolio team so that we can work really closely with these businesses. This shows our exits that we've had in Pastor Evangelist, Plenish and Me&M. Me&M was earlier on this year, 16 times return, returning 15.4 million pounds by way of profit to our investors. Plenish was a much longer hold. In 2013, that returned 8.9 million, and Pastor Evangelist returned 4.6 million by way of special dividends. It is our intention to, when we get exits, as we have proved in the past, to return to maximise returns to our shareholders by way of special dividends. This is a slide that I'm not going to read to you all. This is Pembroke portfolio wins, number of different companies here as to what's happened over the course of the last year. But needless to say, this is an ever-changing slide, and I will let you read how we're doing in each of these individual businesses. But there are a number of highlights in our underlying companies, and they continue to create highlights on a monthly basis. So as I say, this is an ever-changing slide, and hope you enjoy reading it. So obviously in our space, there are no certainties, and we've had to take the tough decision this year to stop funding some of the businesses that we were invested in because we no longer had confidence that they could get out of the problems that they were in. So we have taken a full write down on PlayerLayer, Alexa Chung and Source Market. And as sad as it is to see them go, they were all at one stage they were good businesses. They were in growth. We supported them up to the point that we could do. That is our job being an investor. We have to responsibly measure risk of new capital going in, and in these businesses certain things went against us. In PlayerLayer, we were very much hit by the closure of sport in schools and university for an 18-month period during COVID. Alexa Chung was it was unfortunate that her brand of clothing didn't resonate with the underlying consumer who we thought would want to buy her clothes. And as is sometimes the case, fashion businesses don't work. We took the decision to stop funding that one, so that because we had lost confidence that the brand would resonate with the underlying consumer. Source Market went through a torrid time with COVID and with the shutdown of hospitality. We closed down a couple of sites in London. We were offered the opportunity to go into premium service stations. It seemed like a really good idea, but unfortunately the premium service station market didn't take off to the extent that we thought it would, and that we had been led to believe by the operators. In hindsight, we made the right decision not to continue funding it, as I think premium service station operators, since the invasion of the Ukraine, would have had a really torrid time, as premium operators in service stations with petrol and diesel being the price it is, would have probably been surplus to requirements. So I think we made the right decision on all of these, as tough as it was to take. This is part of what we've got to do. When things don't work, we have to stand up and take tough decisions. Investment deal flow has never been higher. I think not only has it never been higher, but we've never seen such quality, and not just quality in businesses, but quality in where the businesses have got to. So we're being approached by businesses who are slightly further along their revenue curves. They've got better teams, or they've got wider teams engaged, and choosing them now is a case of really cherry picking those very, very best opportunities that we think not only are good first investments, but will give us the opportunity to make follow-on investments as they go on their journey. ESG is very much a buzzword at the moment. Lots of people are talking about it. It's really important. However, we are not an ESG investor. Now, having said that, we don't only look for businesses that are 100% ESG compliant, but what we will do is only back businesses that take ESG in a responsible way. We like founders who think about their staff. We like founders who think about their packaging, their supply chain, and how they run as a brand is really important to us. But we don't only back brands that have an ESG mission. However, all of our brands should take their ESG responsibilities seriously. So having paid out dividends over the last 7 years, we have now upped our target dividend to 5p a year, which we have already paid out this year. So any further dividends will be on top of the 5p that we've already paid. Charges and fees. We like to think we align our interests with that of our shareholders and also that of our underlying portfolio companies. So we have an AMC of 2%. We don't charge any fees for arrangement, exit, monitoring, or direct fees on our portfolio companies. And our performance fee, we feel, is performance fee that is both innovative and very relevant for our market, where it is not paid on NAV, it is only paid on investment gains offset by realized losses. So we don't pay out on net asset value. As we've seen, net asset values can change very quickly from one day to the next, and sometimes not because the company is doing bad, just because of market conditions. So we feel any performance fee should be after having returned real cash to our investors. The timetable for this year, we are launching in September. We're launching actually on September the 8th. We have our half-yearly results in November. Annual investor statements will go out in February, and we will close the offer in April.